Today, I'm going to show you a specific type of ETF distribution that legally removes taxes eating into your profits. I'll show you how it works and compare the two massive funds to see which one does it best. What if I told you there was an easy way to generate massive ETF income without giving a dime to the IRS up front? Let's define what return of capital is. Looking at the Investopedia page, it says payment or return received from an investment that is not considered a taxable event. Let's look at this example. Let's say you buy a $50 ETF. Whether a payment occurs weekly, monthly, or quarterly, it reduces your taxable investment by the amount of the payment. If you get a dollar distribution, you keep the whole dollar. The IRS just lowers your cost basis. It's a non-taxable event until the cost basis, your original investment, is reduced to zero, which is a critical point. In the US, once the cost basis reaches zero, further return on capital distributions are generally taxed as capital gains. That means for us as long-term investors, holding these stocks for over a year would qualify for either 0, 15%, 20% tax rate, depending on your income. So whose decision is it to repay us our investment? As you can see in a Roundhill blog post, they classify their payments as return on capital. They can pay like any other company, or they can classify that income as return on capital. But here's where investors get tripped up. Not all funds do rock the same way. To see the difference this makes, let's compare Roundhill to another popular fund, YieldMax. Here, YieldMax states they are paying 58% of the distribution as return on capital, leaving nearly 40% to be taxed as ordinary income. So why does YieldMax only pay partial return on capital? To understand why, listen to YieldMax's lead fund manager, Jay, explain the strategy.
We probably err on the side of being conservative and tell people, here's what we think the return of capital is. You don't really know, by the way, to the end of the fiscal year. You don't know. You got to have all the gains and all the losses. And then if at that point the income you made, because the fund lost money, gets classified as return of capital, so be it.
Because YieldMax focuses on massive immediate yields generated from options trading, the IRS classifies a chunk of that as regular income. They literally can't classify all of it as return of capital. So what are the downsides? Going back to our example, we can see that a $50 investment in YieldMax will do something similar to what Roundhill does, just at a slower pace. Though the real downside here is that the distribution that you receive looks big, but in fact is less because of the taxable portion you pay, like regular income. Unlike qualified dividends, which are taxed at capital gain rates, we'll pay our normal tax rate, which lowers our take-home and caps the upside of reinvesting cash. So what's the verdict? YieldMax gives you a bigger illusion of cash today, but the IRS takes a massive cut. But if you want to compound your wealth tax-free for as long as possible, Roundhill's 100% return on capital is the clear winner. Let's talk about the 5 highest paying ETFs and how they can produce tax-free income. Can you guess who is first and who is last? Google at number 5. Google is slipping on our charts this week, but before you panic, there might be a secret to playing the dip that you don't want to miss. Let's look at the underlying stock first. Google closed at $311.43, down 1.3% between February 27th and March 6th. This downturn affects Roundhill's ETF GOOW because it didn't make any money on the swap between the 2 weeks, lowering the payout. The ETF is currently priced at 62, making it look tempting, but wait. The Roundhill ETF is up 19% since launch, price of 52. With 81 weeks left to recoup your initial investment, this ETF requires patience. It's a hold for now, but we need to watch Google's price action closely next week. The 4-week total is $1.52, lowest among the pairs of last week. A $7,000 investment right now yields $46 a week based on last week's payout. That's a solid return, but here's what could go wrong. Since it's the lowest payer from last week, if Google keeps sliding, that distribution could shrink. As a bonus, if you did buy today, that would be 151 weeks of tax-free return on capital repayments. Since GOOW requires patience right now, Let's see if its rival, YieldMax GOOY, is where the real opportunity lies. GOOY is priced at $13.30, down from last week's price of $14.02. The sliding NAV of YieldMax's ETF is down 35% from the launch price of $20. If the ETF further erodes, you could get caught in a yield trap where you hold on to collect enough dividends only to repay what you initially paid for it. Looking at the distributions, we're 64 weeks away from recouping the full amount from the launch price. The 4-week total is at 41 cents compared to Roundhill's $1.52. This week's tax from the return on capital is 78%, which means you'll pay $6.10, lowering our take home to $48. So where is this hidden opportunity? While GOOY gives you a slightly better take home of $48 right now, the 35% drop in NAV makes it feel risky. GOOW remains the safer long-term play once Google's price action stabilizes. Look for a buying opportunity on the dip. AMD at number 4. AMD took a dramatic turn this week, falling 2 positions from last week's number 2 position, though it managed to hold on to 4th place. How will this impact your dividend payouts? We'll put AMDW and AMDY head-to-head to see where your $7,000 is safest right now. Checking the underlying stock, AMD closed at $200.21, down nearly 5% between February 27th and March 6th. This price drop will impact AMDW's payment because there's nothing left to pay extra on. So it will default to the ranges that Roundhill has set for this ETF. The ETF price this week is at $39, a bit lower. However, with the recent upward trends, this might be a good buy. As compared to last week's closing price of $42, it's down nearly $3. The Roundhill ETF is down 19% from its launch price of $49. With a slightly higher payment of 48 cents, we're 56 weeks away from recouping the full amount of the launch price. The 4-week take-home is at $1.53. Last week's payment doubled to 48 cents from the previous week's 21 cents, which is a good sign. $7,000 right now yields $84 a week based on the 48-cent payment, a much higher return that underpins how well AMDW is doing right now. If you were to pick this stock up for $39, you'll get 81 weeks of tax-free return on capital payments. Since AMDW is looking like a strong contender, how will the rival YieldMax compare? AMDY's current price is $31, up from last week's price of $30.96. The launch price is at $94 right now because of 2 reverse splits, which extend the dividend repayment period to almost 5 years if you were to purchase today. However, the payments are above average, nearly beating AMDW at $1.26. What makes this an attractive is both the payments and the ETF price. Using the same $7,000 investment, you would be getting $65.59 per week. Then, after subtracting a 7% ROC and income taxes, you would receive a reduced payment of $64.94. Comparing the 2 ETFs, AMDW and AMDY, it's clear that the highest priced AMDW, with its higher average distributions and higher NAV, is the clear winner in this contest. Broadcom at number 3. Broadcom is doing better than I would have expected, only falling 1 position from number 2 last week. Based on a $7,000 benchmark, will Broadcom hit our $300 a month goal? Starting with the underlying AVGO stock, we see it closed at $319.55, up 4% between February 27th and March 26th. We should expect to see a higher price on the next payment due to the money Roundhill earned from the weekly swaps. The ETF price this week is at $40, nearly up $1 from last week. It appears to be rising. The Roundhill ETF is down 21% from its launch price of $52. Based on the remaining distribution portion of the launch price and the last payout, we're 98 weeks away from recouping the full launch price amount. The 4-week total is at $1.59. The payment fell 17 cents from the previous week, though the fund made money. We should see a higher payout this week. Investing $7,000 right now would yield $57 a week, which is down slightly from last week's total. If you were to pick it up right now, you would receive 118 weeks of return on capital tax-free payments. Since Broadcom doesn't have a YieldMax counterpart, we'll instead focus on the $7,000 a bit closer. Starting with the $7,000 investment and a price of $40.94, we see that we can get 170 shares. The next step is to multiply our shares by the last payment of 33 cents. That gets us nearly $57 a week. We then multiply that by 4 to get our total monthly payment of $225.69. Last week, we looked at which of these stocks to get to the $300 a month. and Broadcom, given its lower payment, falls short of that goal. Gold is back at number 2. Last week we set a goal which of these stocks could generate a $300 a month. Today we're testing the Roundhill Gold ETF. With prices bouncing around, will gold's recent volatility help us hit that target or cause us to fall short? So starting with the underlying gold stock, we see it closed at $57.47, down nearly 10% between February 27th and March 6th. The next payment will fall within the range that Roundhill has set, so expect it to be on the mid end given its recent payments. The ETF this week is priced at $61.78, down nearly $2 from last week, stumbling just a little. Roundhill ETF is up 22% from its launch price of $50. Based on the launch price and the recent payment, we're 95 weeks away from recouping the full amount. The 4-week total is at $1.73. The payment rose by 1 cent from the previous week. Investing $7,000 right now would yield nearly $54 in return this week, which is slightly up from last week's total. If you pick it up, you'll receive 129 weeks of return on capital tax-free payments. Since gold doesn't have a YieldMax counterpart, we'll instead focus on the $7,000 a bit closer. Starting with that $7,000 investment and a price of $61.78, we see that we can get 113 shares. The next step is to multiply our shares by the last payment of 47 cents. That gets us $53.25 each week. We can then multiply that by 4 to get our monthly total payment of $213.01. Last week, we looked at which of these stocks could get us the $300 a month, and GLDW, due to its lower payment price, falls short of that goal. The gold miners are back at number 1. Last week, GDXW hit our $300 passive income challenge. But after a stumble, can it hold its title as the best ETF on the market? Or is it YieldMax's GDXY about to steal the crown? Let's find out. Looking at the underlying GDX stock first, we see it closed at $115.84, up a nice 10% between February 27th and March 6th. With that nice price increase, our payment will definitely go up. But by how much? The ETF this week is at $63.40, down nearly $12 from last week, literally falling off a cliff. The Roundhill ETF is up 26% from its launch price of $50, but it's down from the previous week recent high of $75. Looking at distributions, we're at 41 weeks away from recouping the full amount from the launch price. The 4-week total is at $323. The payment rose by 9 cents from the previous week. A $7,000 investment right now yields $102.68 a week based on the 93-cent payment. This is the most profitable ETF on the market due to the higher payments. If you were to pick this up for around 61, you'd get 65 weeks of tax-free return on capital payments. So GDXW gives us a massive 102 a week, but we have to wait 65 weeks to get it back. Now, how does the biggest rival, YieldMax GDXY, compare? GDXY is priced at $15.89, down from last week's price of $18.24. The YieldMax ETF is down 16% from its launch price of $18.96. Looking at distributions, we're 27 weeks away from recouping the full amount from the launch price. The 4-week total is at 86 cents compared to the Roundhill $3.23. Using the same $7,000 strategy, you would get 447 shares at $15 per share and receive $85 this week. Wrapping up, in both cases, we would be well over our $300 a month challenge. YieldMax is showing up at $334. The downside here is the NAV and how YieldMax pays. The lower the stock's price is, the less they pay. Whereas with GDXW, even while down a few dollars from that high of 75, they're still paying over $100 a week, and we still see positive numbers above their launch price, which to me says GDXW is the clear winner. Well, that's it. We're at the end of the video. Thanks for watching. We'll see what happens next week, see if any of these stocks make it back onto the chart. Please consider dropping me a like and subscribe if you like the content. These videos do take a while, but I hope to have some long content videos out here soon. Thanks for watching and keep dreaming.